Well, hello again, Solis Wealth family. Greg Solis here with the update. First of all, on the family front, we sure had a great time out at the American Express Golf Tournament in January. The tour comes into town and it's fun. We have a lot of people in town and friends and clients and we sit at the 17th green of the so-called stadium course. They call it Alcatraz, and we have the privilege of watching those tour players come through. So we just had a great time. Kind of a funny story. The kid that won it, this Davis Thompson kid, or came in second place, had a chance to win it. Jack had the privilege of playing with him at La Quinta Country Club the week before he shot a 62 out there. So he was a nobody. He was a rookie on tour, and it was neat because he got set up to play with him. And someone had asked for Jack to kind of show him the ropes at La Quinta Country Club, and he shoots a 62. And going into the last day, he was one under behind Rahm, and unfortunately, he missed the putt on 17 to take it to a playoff. But anyways, it was a great time. We had a blast, and Jack felt a little bit better being able to play with Davis. But a fine young man, and he's got a bright future for sure. So family-wise, we're good. Hope your family's doing well also. Market-wise, little better months. January was good. The Fed did raise rates another 25 basis points last week. We were anticipating that. We're at about 4.5%, 4.75% on the Fed funds rate. Definitely starting to see them slow down after raising it 75 basis points real aggressively. We haven't seen that kind of an aggressive move since the early 80s to move the Fed funds rate up that quickly. But it appears as though they're tapering. Powell came out, the chairman, and said that we could see things slowing down on the inflationary front. And there's really more risk now, probably on the recession side than there is on the inflationary side. So the rhetoric is definitely changing to slow things down on raising rates. Some of the inflation numbers that are coming out, we're seeing those slow down quite a bit. That's good to see. And so we're seeing the stock market beginning to rally. Is that you hear me say a lot? Usually the market is looking out 6 to 12 months out. It's not as concerned about what's happening today. So with the Fed potentially starting to slow down on raising rates, maybe raise them once or twice this year. And some analysts are talking about them maybe even starting to lower rates, maybe even as early as the summer. But certainly towards the end of the year, that could very well happen. So as rates begin to come back down, we might see the stock market continue to run. The bond market looks a lot more stable. As I've mentioned before, we're getting good yields on bonds. We haven't seen that in a long time. Literally in a decade, over a decade, since we've been excited to buy U.S. Treasury bonds, short-term Treasury bonds, for example, up over 4.5% still. So that's great for portfolios to be able to capture that additional yield. So we feel that the bond market's stable. We'll be able to earn some interest on the bonds. Equity markets are starting to recover. So things are definitely looking better. And we've had a pretty nice move since it appears to have hit a bottom in October of 2022. We hope that's the case. And maybe we're going to run up a little while. So hang on tight. Portfolios are looking a little bit better. That's great to see. And hopefully 2023, January is hopefully going to be a kind of an indicator of what might happen in the rest of the year. Let's hope so. But if you need us, you know we're here for you. Never hesitate to call, and we'll keep you posted on our end, but we'll look forward to seeing you real soon. Take care and God bless.